Hey guys, happy Sunday and welcome to another webinar for secret trading combination or secret investing combination, whichever one you want to call it. So guys, this session is slightly different. I stated on the Telegram group that it's going to be very important. And I feel that the reason a lot of people struggle in investing their money and why it seems like the rich keeps getting richer and the poor don't have a fighting chance is because of two things. Number one, the rich have certain information that you know, that they know, but you don't know. And number two, nobody that is rich ever reveals everything that they know, right? But I believe because as humans, we're collectively connected via our access to certain spiritual paradigm or certain part of the human psyche, we can gain access to the collective unconscious and tend to know what the rich know if you pay good attention. And what I'm saying is, I don't know what religion everybody is that's watching this. I presume you have various religions, but whatever it is that you look up to, or if you don't look up to, if you believe in yourself, whatever it is, right? If you get close enough to it, it will show you the secrets. Now, you're here for a reason. And I feel like I'm also here for a reason for you guys. So I'm going to show you something new today. I've never shown you this before, but I'll show you. And it's right in your faces every single time, right? There's two different asset classes you can trade, right? In this site that we have, maybe three on our current website. So we have the Forex classes, asset class, and you have the indices, right? Now, with the Forex, and you have the crypto and all of that. I don't have much crypto. I think it's only Bitcoin that we have here. But with the Forex and the indices, there's a difference. And I'll show you the difference. Look at GBP USD, for example. Right? So, GBP USD. We go here, we look, we try to get in here, get out here, we sell here, we get out here, and all of that stuff. We make money sometimes, we lose money sometimes. But look at this sentiment. See this right hand side, this sentiment, you're looking at the right hand side where it says performance, right? You can see, and the technicals at the moment, you can see how many people are going short, like how many going long, depending on whichever broker this is. This is FXCM. So it shows you that sentiment, right? But overall, it shows you the performance over the year, which will be similar on every single broker because this is coming from a centralized base, right? If you look at this, would you ever want to put your money in this? If someone tells you now, look, I've got this great asset for you, man. You can invest your money and you make a lot of money in it. And you're gonna do good, you're gonna do well, and everything is gonna be good for you and all of that. And you're like, okay, cool. I got $100,000 to play with. How much am I gonna make? And the person tells you, if you invest your $100,000 in 1 week, you have $95,000 left. In a month, you're gonna have, let's say, $60,000 left. You understand? And in 3 months after that, you're gonna have $14,000. But don't worry. After that 3 months, you're gonna come up to $39,000. And then after 1 year, or roughly about a year from now, you're gonna have $70,000, right? And this 1 year to date is basically the same date now. So if it was 21st of June, it will be 21st of June last year. You understand? So what's this? Yeah. So it's gonna be 21st of June, somewhere around back here. I know I don't have to do this just for illustration purposes. It's gonna be around here, right? What was I gonna say? Around here. So it's gonna tell you like, oh, if you invest your money here, you're gonna be here in 1 year. You're gonna look at that person like, are you crazy, right? I give you $100,000, and at the end of a year, you gave me $70,000, and you said it's a good investment, right? Now you can say, oh no, that's a flip, right? Or doesn't make sense, right? Let's look at another Forex trade. Let's go Forex right here, right? USD. This is what it has. Same thing. This time around, they tell you, man, you put $100,000 at this point, you're gonna bust. You understand? But that's a good investment, right? Oh, it's a fluke, right? Now, I'm not knocking FX down because primarily this side was built on FX, right? Now, I'm just showing you an angle. The rich does not show you everything that they know, right? Let's take another asset. Right? Oh, this one is good. 1 year from now, you're gonna make 12%. So that's $12,000 on your 100,000. You're gonna be happy, right? With this one, right? Start picturing the overall picture of what I'm getting at right here. All right, let's go. Another one. $13,000. Now, if you look at the last two assets I've shown you, they're on the JPY spectrum, right? Because JPY has been getting pounded so hard, like a freak. He pounded so much. That's why you're seeing this. Now let's look at something totally different. Let's take this JPY out. Let's go down here. Let's get entertainment. Yeah, here's the CHF. Let's see what that has for us. Right? You can see 6% yet today. That's good. But if you look at the overall year, it's down. Right? We get the picture, right? Let's choose another one. You might be saying, okay, yeah, I get the point. No. I like to bang the point in. Right, so you get the point. JPY is gonna possibly look good for us right now. This is what JPY looks like. You can see 9%. JPY has been pounded basically. JPY is a freak right now. Now look at AED. So if you've noticed the pattern so far, the ones that are JPY based on FX, you have that movement going positive. But majority of the ones that are not JPY based have a negative base or a very small percentage gain. Right? Now let's look at gold, for example. You can see that 12%. Looking at gold alone, you go 12%, you go 21%. Right? That's 1 year. Let's look at S&P 500. You got a 15 and you got a 25, right? Percent. If you zoom that out, look at it. Over time, what can you tell about this? It's a horse. Right? It's a horse. Rich people dump their money and forget about it. That's the basis of using seasonality in the first place. That's the basis of using COT in the first place. Look at this. This is NASDAQ, right? Look at that. 18%, 33%, right? If you zoom in, you can see it's a horse. UK 100. These guys are quite funny out there. Not as horsey as the other ones. You can see its economy is not that, effective or robust as we think it should be. But that's another one. Let's look at this, for example. Nikkei 225. 16, 15%, right? CDGI. 4%, but overall 15%, right? And these guys are horses. Majority of the time when you see this drop, this was most likely COVID-19. This massive drop you saw right here, that was COVID-19, right? But after COVID-19, you can see the massive increase in momentum. That's because of the money that was pumped into the market after COVID was ridiculously high, right? You have to ask yourself, why did they pump that much money? Look at the S&P 500, NASDAQ, for example. Look at that. There was a drop right here. It was before start of 2019, and then you see that COVID-19 drop, right? That's when it went into full effect. So when lockdown started, that's when you've seen that. But look at the distance it's moved from here, down here, to all the way up here, right? Why did this move? If you look at this amount here, if you count the boxes, let's say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I know I can do the pips count. I'm just doing the boxes count. 13 boxes, right? Right? Look at that. In the past, how many years? From 2020 up to 2024, 4 years, right? That's not the same amount of boxes from here all the way down. If you count from here, 1, 2, 3, 4, 5, 6, 7, 8, right? And if we look as far back as 2012 or even 2011, are you seeing the size of the boxes doubled in front of your eyes? Why did that happen? There's more money printed in the market. The market is flooded with money on these guys. These guys will keep pumping because of the money that's been flooded in the market. There's more money in circulation now than ever in the human history, right? And the rich keeps getting richer because they know when to go in. Then you after COVID, the economy is going to tank. Once everything starts picking up, you dump your money in there. Now you're smiling, right? So let's go into something a little bit more logical. Let's do a little bit of calculations right here. All right, so this is if you put your money in a bank, right? The average return on a very high standard bank on savings account, you're gonna have 5% something, 5.something%, 5.25, right? The best on offer on these guys, right? In some countries is less, maybe 1%. I mean, yeah, so 1% interest rate, some having 2% here, 3%. I know some banks pay 1%, and I know some pay 0%, right? So what you notice is these guys are like 3%, 3% right here. This is Nigeria, by the way. This is Nigerian ones. 10%, 3%. Well, internationally, let's say 5%, right? Because also they have to be in accordance to the interest rates of their central bank. Keep that in mind, right? And that's not always high. So if you have, and also it also correlates with the lending rate. Instead, the lending rate cannot be lower than the interest rate because then you can just borrow money from that bank and put the money back into the same bank, and now you're making some extra cash for yourself. So what the bank is doing to you, basically, you're doing to them. So keep that in mind, right? Now, if you have a 5% increase yearly, and you dumped your money, right, on a high level, 5%, and you have 1% on a low level, right, and you put $10,000 in there. By year 2, you're gonna have $10,050, $500, $10,500 if you're using a 5% rate, and if you're using a 1% rate, you're gonna have $10,010. So looking, this is the majority of the FX. I mean, the best FX we've seen today is about 7% or something like that, right? Maybe slightly higher. I can't recall, but let's actually check JPY and use that as a correlation because it's only JPY right now that is looking very, very high in the FX. Let's look at JPY. Let's see what it has. Okay, we got like 12%, right? That's the highest, and the probability of finding that on the FX is very low. Keep in mind, it's because we know JPY has been pounded this year. That's why you get that. Now, keep in mind, it's not consistent every year, right? So it's different. At the end of 10 years, you're going to have 27,000. So if you drop that money today, you close your eyes and say, I'll come back 10 years time and come get that 12% from JPY. Keep in mind, JPY is not going to let the economy get pounded for 10 years in a row. So your ideal figure, let's just use the bank rate. Let's say 5%. That's if you left it in the bank for 5%. I don't think banks will give you up to 12% on your money. So we leave it in bank savings account, right? Savings bank account or FX. You find a super good year that gives you 5% every year. By the end of the 10th year, you have 15,000, right? Now, if you put your money in indices, for example, there's other assets as well out there that you can put your money out into, but so far it has a very high return. What you end up with will be totally different. So if you have 25%, you can see at the end of 10 years, you'll have $74,000, 505 and 81 cents. Right? That's what you're gonna have. Now, if I put same $10,000 here, you're gonna have $35,000, 178,076 cents. Compared to if I left it in the bank, I would have had on the higher side 15,513,028 cents. Understand? Or on the low side, I have $1,093.69. So you know, it's quite. This should be indices, by the way. You know, like I just done this, by the way, before I started this webinar. So if you look at this, it's a no-brainer. It is an absolute no-brainer, right? What's happening in the market? Most of the rich guys don't really go on FX that much, unless they know something's happening, like the JPY one, for example. They tend to stick with these guys, or they stick with the bonds. You know, there's so many other right there. Let's go, for example, trading view is a glitch in the matrix, by the way, because with this feature right here, if you go on indices, it's gonna show you so many other indices around the world, right? So we can look at the Nifty 50, right? See what I'm saying? Majority of the indices are killers. See, 8% to 24%. If you look at them, let's zoom out. It's most likely a horse. It's a horse. Just keeps going, man. Look, 2003, 2004, this damn thing was less than $1,000. Look at it now, $23,000. Let's look at COVID. See, after COVID, what happened? After lockdown, they pumped a lot of billions and trillions in the market. Look at that. Take out all the money they pump into the market. That's the COVID money you're still seeing the residue right there. Understand? It might look like, oh, COVID is a long time ago. Dude, to the market, it's not. Because that money is now in circulation. That money is not going anywhere. It remains in circulation. Have you heard of any country delete billions from their company account, from the country account, or the country treasury? It's not possible. Once you've created it, you've created it. In there, it's in circulation now. Then you have tools like inflation rates, interest rate to try to manage the money that's in there so it doesn't go bust, right? So the entire thing doesn't lose its mind, right? Ultimately, this is where the crown jewel is. So today's session or today's webinar is primarily about this. I'm not going to look into any asset classes for you guys. If you have the tool, you know, go on the website, go check the tools, check which assets are going to be beneficial to you. If you don't have the tool, check the link in the description to get the tools or to join the Telegram group, right? But keep it straight, guys. This is how the rich get rich. And this is why it seems like the FX market is rigged against you, because you're probably trading this. And the most favorite right out of the FX market is, let's go, Euro USD, right? Let's look at the percentage in that. That's the favorite. You can see it at the top right there. It still is killing you. You can see some of my lines I drew on it. It's from a long time ago. This thing is killing. This is literally bust. 44. You lost 44% already in 1 week. Look at the market. We did well with the seasonality, and we're still doing well with the seasonality, probability, and COT, getting these type of moves. That's why we get an 80% win. But I'm upgrading you guys now, moving you away from stress. And if you've looked at my webinar over time, I'm more into indices now, mainly because of the EA that I have performs better on indices than on FX. Because all you need to do is set the direction, and that's it. So it's easier now, right? And there's no point of me having something better and giving you guys something that is outdated, right? That's the new information, and that's why I said you don't want to miss today's webinar, because of this. Before you trade any assets, or before you do anything, check this. The performance. That's why I said trading view is a glitch. It gives you an insight or overview of what to expect. Now, if you want to be a superhero, right? Captain Save a Hope, you can go in there, do what you need to do. Excuse my language, by the way. If you're not 18, you shouldn't be on this channel, by the way. Set to less than 18. You understand? So if it's less than green, if you don't see green yet, run away from it. But you can do the inverse, right? Just sell the damn thing most of the time. Just sell it. But I wouldn't suggest that. You know, have peace of mind on something that you know has a lot of money going behind it. You know, and yes, don't be adventurous too much in the market. All right, guys, that's all I have for you. I will catch you on the next one. I hope you enjoyed this, and I hope this has been helpful. So this is just for illustration purposes only, so I won't be sharing the link to this to play with. But if you want to, you can always do your own and do your own computation. All right, guys, take care of yourself and have a lovely one.